Hello and welcome to Talking Point. I'm your host, Niraj Shah. Our guest today is Rajesh Bhatia of ITI. Rajesh, great having you. Thanks for taking the time out.
It's a pleasure to be here and wonderful office, so congratulations on that.
Thank you so much. We're just starting off. Hopefully, we can do justice to the office via the content, and I'm sure with you we will. So, Rajesh, just a quick reflection of what we did the last time, and then we'll come to the current views. But when we spoke to you the last time, which was maybe 4 or 5 months ago, I don't remember exactly, amongst the things you had said was that India was looking amongst the most predictable stories around EM, DM combined maybe, because DM was anyway struggling for growth, and a bunch of EMs also were not doing as well. Now, India has had a great 2023. Probably not the best performing market per se, but from amongst the larger markets, arguably amongst the better ones. What's next based on what you had thought of then and what we've traversed from there until now?
So, Neeraj, a lot of things haven't changed since we spoke the last time. I think the challenge of the developed markets to continue to grow, I think kind of persists, and the perception that India is one of the most predictable opportunity over a 3, 5, 7 year, 10-year period, that kind of remains. I just want to kind of step back and talk about what is the genesis of this rise that you are seeing, valuations and enthusiasm apart. I think the genesis of this really has been the fiscal spend by the government on capital expenditure starting the COVID crisis. So as a response to the COVID crisis, the central government of India started spending money, and kudos to them for kind of doing that. And by the way, that number is at a close to a 20-year high as we speak. And that meant investments in roads, railways, right? Streamlining defense, etc. Power now, and of course, concurrently, a real estate cycle taking off. If you step back and look at it, there was a 2003 to 2008 secular run that we had. The last 3 years of that was 9% GDP growth rate for India. Of course, that was a capex boom, capex bubble, if you can call it. And then that kind of resulted in corporate balance sheets smashing the way down and bank balance sheets also kind of deteriorating quite sharply. And then we had a 10-year of NOE, right? 10 years, 2012 to 2021-22, there was no capex cycle to speak of really. And from there on, the last 2 years, there has been again a rise. These things usually have a life of 3, 5, 7 or 10 years, right? So that was really the genesis of that, and therefore how it pumps up kind of demand for the economy makes me extremely comfortable that this is a secular trend that is kind of going to keep a structural growth rate for India over the next 3 or 5 years. So this is among the reasons why India is kind of poised for probably I would say predictable and structural growth as you move forward. A lot of things have come together for India. The macros have been very stable, right? The balance of payment, etc. Inflation has actually come off, right? Interest rates are actually now kind of trending down. Because the globe is not doing well, commodity prices have been kind of low, which is great for India because we're an importing commodity nation, and that helps corporate earnings. And on top of that, now you have this capital expenditure cycle, which is now where balance sheets of banks are at the best they've been in the last 10 years. The balance sheet of corporates have been at the best. So there's a confluence of good things that have happened, which is the foundation of this rise that you're seeing.
Okay. And it's not necessary, and we'll keep on dabbling between the macros and the markets, but it's not necessary that markets necessarily follow economic growth to the T. At times it overshoots, at times it undershoots. Currently, markets may seem optically expensive. I heard you say that economic growth will stay likely strong for the next 3 to 5 years at the very least. You reckon markets will stay strong too?
Yeah, so what I am comfortable with is, what's the most dangerous point of the market? When you have a last stage of an economic cycle and you're at the last stage of a market cycle. If you look at 2007, 2008, and because it was the last stage of the economic cycle and the last stage of the market cycle, and that resulted in the worst market return in 30 years when the markets dropped by over 50% during that time. Today we are at an early stage of the economic cycle. So we may be at a later stage of a valuation cycle, and that may correct, but that kind of consolidates because economic momentum will still kind of continue because we are at an early stage. So I'm not as worried about where we are on the economic cycle stage. Of course, there would be some pockets of exuberance on the valuation side, especially on the mid-cap and small-cap side, but that means you'll have to just give it more time.
But I think one of the points that you had made the last time was that the breadth of the market actually implies a strong quality of market. And in some ways, Rajesh, the number of sectors which are present, which do not have a large cap presence, is very large now. So if you want to participate in those sectors, you have no choice but to not be in the large cap arena. So is this whole fear around mid caps and small caps having run amok also a bit overstated? Because even if that happens, and yes, that has happened, but there are a clutch of names out there which will probably continue to stay strong for a number of months, quarters, or years.
No, I think you hit the nail on the head. So a couple of things I'd like to say. First, that your point, that observation that the breadth of the market is very good. You can see that, right? I mean, there are just so many opportunities that are kind of going up, right? There are so many sectors which are participating. That means the quality of the market is very good. That, and we had said that the last time as well, that means that it's not likely to peter off that quickly. So the strength of the market has been really strong, and that kind of continues even as we speak. The other observation I would make is that while there is a lot of talk about mega caps being where the value is, I don't want to make a contrarian statement. Mega cap is where the value is, but mega cap is not where the India story is, right? The India story is taking place outside of the mega caps, right? So if you look at the defense themes, the power themes, the EMS themes, etc., the real estate themes, they are not in the mega caps. The mega caps, while they will do well and give you equity type returns, but I would say that the India story is really happening elsewhere. So while valuations, and therefore there's a reason why those valuations are ebullient, but even if they're correct, you're right in kind of pointing out that still is going to be a multi-year kind of a phase. So you will have valuation corrections in those sectors, but pay attention. This is where the next 5 or 10 year story is.
Okay. And viewers, I won't get into the details of that, but I'll tell you, one of the things that Rajesh believes is that for the market momentum to stop or reverse, it now requires negative news to stop the rally. So keep in mind that by itself, it may not necessarily be a pause or a reversal unless there is a large negative news. But I want to quiz you on this one before we go to break. I note down that line, mega cap is where the value is, but not where the India story is. So where is the India story?
So India's story is in the diversity of sectors that I just pointed out. Of course, it's in the capital expenditure cycle, which is real estate, power, electronic manufacturing, defense, etc. I would say select pharma, telecom, which probably is a mega cap, but definitely that's really where the India story is. Select auto ancillaries, select non-banking finance companies, so on and so forth. So that's really where the India story is, as you move forward. To that point, I just want to clarify what I just meant by it requires a risk factor. See, India is in a momentum of its own. So it's like Newton's law. When something forms a momentum of its own, it requires a opposite factor to kind of stop it. So I think we are in a momentum as far as, because thanks to the fund flow, thanks to the positive narrative that we have, it's possible that there is some risk factor that emerges that stops this juggernaut that we are in. But until that, if that doesn't happen, my fear is that we will go into an irrational exuberance. And that's a high possibility unless that risk paradigm kind of manifests itself. We were worried about, it's always good in the market to have some risk. So if there was a possibility of an election outcome which is uncertain, it's good to have that. Then the market doesn't go to an exuberant stage. It was always good to have inflation as a risk. But now that US Treasury yields have moved softer, and given that there is a consensus that interest rates are poised to come down, that means that consensus is lost, and the market then sees only positives. Then the risk becomes the market itself, the valuation weight itself. So if the market goes into an exuberant level, minus a risk factor emerging, that will become a risk to the market, as you move forward.
As we slip into the break, note the point. Rajesh doesn't believe that we are in an exuberant state as yet, though. So that's the key thing. We stay on, Rajesh. We slip into a quick break. On the other side of the break, we'll try and dissect some of these themes that Rajesh spoke about, is where the India story actually is, the whys, the why nots, and the risks of some of this. Coming up on the other side. Stay tuned. Back with Talking Point in conversation with Rajesh Bhatia of ITI. And Rajesh, we've established that you don't believe that there is exuberance in the market, even though there is optimism, yes. And while there is a rally at the non-mega cap, that's where the true India story is. Now, I want to start off with something that I started off, or you started off in the first segment, and that is CapEx. We haven't seen too much of private CapEx except for select sectors, so maybe this gets restricted to public CapEx. And you mentioned we've started then since 2020. But there's this chart that you only had shared with me at a point of time, which shows just how swift the set of CapEx has been. I would love to understand from you, what are the investing implications of something like this, and whether that has already been discounted or there is still room to go?
So the valuation part is a little difficult to kind of comment on, because so let us say these public sector companies, which are, let us say, in the defense sector, right? They were trading at 10, 12, 15 price earnings. Now they're at 35 times forward earnings, right? So it's difficult to kind of point out that that's really where they will stop. Are they cheap? They're not cheap. Are they slightly expensive? The answer is yes. They are certainly expensive. But the fact is that a lot of people are trying to kind of discount the multi-year story. I would not say that these are good entry points for some of these sectors. But the point I'm making is that valuation is a little difficult to comment on. But let us say a sector like real estate in the capex cycle, right? Now, you're seeing pre-sales double in the last 3 odd years. Now, what typically happens with the real estate cycle is it starts with pre-sales, right? Then what happens is your quantity or volume inventory starts to drop because it gets consumed. Then you start having price increases, which means your margins kind of increase quite sharply and your free cash flows increase sharply. So we are at the start of that cycle, So if you can understand what I'm saying. So which means that as analysts, we will tend to underestimate the potential upside of profits in something like this as you move forward.
Okay.
So if that is a case in point that I can...
Can we kind of probe this a bit, right? And we'll do that each bite. So sorry, we're now doing real estate, then we'll talk about the others as examples of the capex. Maybe the whole show gets consummated in that, but be that as it may.
So
a lot of conversation, ranging from, I'll give credit to Chris Wood for being a global voice who identified the Indian property cycle way early and kept on harping about it. But a lot of global to local voices talking about this. I would love to understand from you, do you believe this to be a multi-year cycle in which we are in the midst of, part one? And what's the best way, therefore, to play this? Because if indeed what you're saying is true, then one, it's not just the real estate ancillaries, the real estate players themselves might be great ways to play this as well. So please help us understand this.
Absolutely. So, like I pointed out, again, like the capex cycle, you had a decade of, nothingness in the real estate cycle. And then the last 2 years, it has kind of picked up quite significantly. Last 2-3 years, it has picked up quite significantly. And it could be a multi-year kind of cycle. So yes, I would concur with that. And given the drops in inventories that we are seeing, it's quite plausible that it moves to the next level, which is as inventory gets consumed, you start getting price realizations and margins expand significantly. I will admit to that the way we have paid real estate has been through the beneficiaries of real estate, which has been, financiers or cable and wire companies or the other components that go into real estate. So we have been more that we feel that the quality of those companies is much easier to establish, the moats are easier to establish, and the predictability of those earnings are easier to establish than the real estate companies. But probably if that is the phase that we enter into, then I think, yes, even the real estate companies will surprise us on the upside as far as their price performance is concerned.
By the phase, you mean that the phase of price increases as well as newer construction coming up?
Absolutely. Okay. So you will have volume growth, you will have price growth, and therefore you'll have very sharp margin growth.
Are there geographical preferences that you have?
I would say go company-wise, right? That's really where I would kind of say it. Of course, the NCR region has done extremely well, and so has regions like Bangalore or Hyderabad. But I would say do a micro assessment of your investments based on the companies that you're comfortable with. Historically, people are not comfortable with real estate companies because of the governance practices that some of these things entailed. And that's why they kind of prefer to play it like we did through financiers or cable and wire or other type of companies. So historically, that has been the case as far as infrastructure developers are concerned, including real estate.
All right, just one last question on this, Rajesh. There are some thoughts that if indeed inventory, as you said, have come to multi-year lows or thereabouts, and if newer construction picks up, then ancillaries actually becomes a really good play because the demand really comes up. Now, there are multiple ways or 1,000 ways to skin a cat. I'm just trying to understand what within this ancillary bucket do you believe can give the best bang for the buck over the next 3 to 5 years?
As an analyst, I can tell you, and I've been an analyst for like 30 years, never have I seen so many TAMs, right? Total addressable market for so many sectors.
Being so high.
Being so high. So every sector that we look at, and we look at what can this be in 10 years? It can be 4 times, it can be 5 times. And there are just the India opportunity in so many sectors is so high over the next 5 or 10 years, probably even longer, that it kind of surprises us. So as some really great investor in India said, it's a buffet. Right?
We know who you're talking about.
Right.
But yeah.
And you take what you want.
Yeah.
So you take what you understand.
Something that has looked slightly, how do I say, not so predictable has been consumption, especially at the rural end. Now, that's what I want to end our conversation with, premiumization and the other forms of consumption. I want to start off with the other form of consumption. A lot of chatter in sell-side notes about rural recovery around the corner, bet on some of those players, etc. The reasons could be manifold, including election-linked reasons as well. Do you believe in that argument?
So far we haven't seen evidence of that, honestly. And, we've been calling for a rural recovery for the last 2 years.
Exactly.
Right? So we'll wait until it happens. And so let's say if you look at one of the large cap stocks in the consumption staples sector, probably it grows volumes at 3%. Now, why would I want to play that in India, where there are, we took out a list of companies which are growing at trailing 12 months, 20% top line and bottom line, with market cap greater than 1,000 crores. We found 200 companies in that. Right? Now, I'm waiting for this company, which is growing volumes at 3%, to eventually grow volumes at 8%. And it quotes at 55 times earnings. Right? So why would I want to wait for that opportunity? I have so much to play and capture the India growth story. On the other side, where there are so many sectors, so many companies which are growing at 20% plus. And, that's really where the bulk of the wealth creation is going to be made. So my focus is really on these type of opportunities as against the consumption plays. In case it recovers, we'll take a call then, because we don't know when that's going to happen. But it is surprising, to me also, that the India, 1.4 billion people, opportunity in consumption is not taking off.
Yeah, it is.
So maybe it's a matter of time. But
might as well wait for it.
Yeah, I don't want to preempt it.
And that's a great way to do it. Succinctly put, but thank you for that. I have 30 more seconds. I would love to understand the premiumization story. Is it for real? Would you play it for multiple years?
So we are playing stocks in that theme as well. The premiumization theme definitely is for real. It's certainly all around you, including in real estate. There's great demand for premium and luxury products. So yes, there are specific examples, I think, which we are all familiar with, which are really doing well in the market as far as premiumization is concerned. But yes, if to put it in very short terms, yes, it's a multi-year theme. The number of families that are going to earn a certain level of income, 5 lakhs and above, in the next 10 years is going to go up over 2 times. And that means the consumption of premium and luxury goods is going to skyrocket as you move forward. So certainly that's a theme that we are fairly encouraged by in India.
All right. Rajesh, thanks so much for being in our studios and giving us such lovely insights. Really appreciate your time.
Sure. Thank you so much.
Viewers, the takeaway for me, mega caps is where the value is, but that's not where the India story is. I leave you with that thought. Ponder over it. Thanks so much for tuning into Talking Point today. Arey wait.
Sensex and Nifty opens higher on Thursday, tracking positive global cues. Broader markets in tandem with the benchmarks. Mid-caps and small-caps gain around 6.5% each. Most sectoral indices in the green. IT and realty see marginal losses, in auto and consumer durables emerge as top gainers. Meanwhile, Polycab